This is IPO readiness and execution. Now, I know we've touched on this subject indirectly on the first panel, so that was meant to be more of a macro look. We're going to drill down to what specific companies are doing to prepare. In light of that very interesting conversation we just had, I'd like to ask all four of you, and by the way, we have Hunter Stenback right here, who's EVP at Edelman Smithfield. We have Sherry Major, who's a partner at KPMG, specializes in IPO readiness, leads that practice at her firm. We have Leonardo Anselmi, who's a partner at CFGI, who also does a lot of work helping companies prepare for a market debut. And we have Brad Ross, as a partner at Goodman's, who also works deeply in capital markets and IPOs. So let's start with Sherry. Do you have any thoughts on the conversation we just heard as far as how, or on the first panel, as far as how the election is going to impact, plans to go public?
Yeah, certainly. I would say like most of the companies that we're working with and talking to see this change in administration being favorable for helping to open up the IPO markets as well as M&A markets. And so I think companies who were already on the path to get ready are thinking about maybe accelerating that. And I think others are probably jumping into the fray maybe with a little bit more vigor than, while they were waiting to see what the results would be.
Makes sense. And Hunter, you don't have to, actually, if you want to go, Leonardo.
Oh yeah, so maybe I just add that, for this new administration, probably there is a more focus on specific sectors rather than others. So if Trump always prioritized deregulation, so I would say that probably there will be more emphasis on sector like financial services, energy, or industrial, rather than biotech and health tech company. They're like more based on the policies, which will be more on the Harris administration. So I think we're gonna see company more on a specific sector going public this year compared to other companies that we've seen in the past.
Gotcha. Hunter?
Yeah, I think the other thing is that it just eliminates some uncertainty, right? So regardless of the outcome of the election, the fact that it's now behind us, I think allows 2025 to be another opening of the window. Obviously, the way interest rates are trending also says that 25 is opening of the window. And so, I think it's really about making sure that you're ready when the window does open, almost regardless of the outcome of the election, just that it's behind us. Gotcha.
Brad, I might give you a slight variation on that question. Brad, how might this impact companies in Canada who are thinking about listing in the U.S.?
Absolutely. It's probably a different effect. Clearly, it's had a great effect on the markets. Our markets, Canadian markets, international markets, have piggybacked on the great U.S. results. The caveat or the difference is that a number of large Canadian companies and others who are looking forward to accessing the U.S. capital markets are waiting to see what he does on trade and how that might affect their businesses. So it's a little bit different for those outside of the borders.
But on that note, Brad, do you see, I can't remember if I've asked you this question before, do you see in 2025 some big companies from Canada listing in the U.S. or potentially?
Absolutely. We're certainly getting ready for it. I'm working on a couple right now that are looking at it, one likely early in 25 and one a little bit later, and it's absolutely a key focus.
How does that normally work, by the way, Brad? Do they list simultaneously? Do they list in Canada first and go and then I don't want to say uplist because it's more like cross list?
It is. I would say it is an uplist.
All right.
Absolutely. I think it's a good term. That there are two ways to do it. Some of them will list sort of concurrently with a Canadian and a U.S. exchange. Others will list in Canada initially and effectively use a process we call the MJDS system that allows you to be public in Canada for a year and then use a bunch of that disclosure to go public in a much more efficient way in the U.S. We see both approaches used.
I really like the point you made about the trade issue. Would that be true for other countries too? Have you guys thought about this? I don't know what the percentage of international listings at NASDAQ and NYSE are, but it's pretty significant. Are those going to be put on pause until trade issues are ironed out?
Well, I think that, that could be a reason why we're going to have less cross-border type of transaction. I think it's important for the company understand what is the relationship they're going to have with the new administration. So we've seen a lot of companies going public from outside the United States, according to what is the trade policy in place, right? So if Trump is promising, for example, to put tariff on China, and we've seen a lot of biotech company coming from China getting public in the United States, it might be a little bit of a refrain. So people are still waiting. I would say that probably the first quarter of 2025, people will be in standby compared to maybe March and April when they understand better what policy will be in place. Then we'll probably start going back to the United States.
Okay, great. Let's shift gears and talk about the testing the waters process. So these are investor meetings companies have with companies before they go public to kind of feel out appetite. Sherry, let's start with you on that. When companies go into those meetings, how prepared are they? Are they ready to go tomorrow or sometimes not quite there?
So it depends when they're starting those meetings. So one of the things that we advise companies is take meetings early and often. And so depending on where they are in that process, there's always some fine tuning to be done. So I would say definitely they take a few iterations before they're really ready for the meetings, but I think the more practice, the better. And the more visibility across the investor base, the more discussions that are being had to create awareness, it just helps with the entire process.
Gotcha. Hunter?
Yeah, I mean, look, they're great for feedback, and so the earlier you can start, the better. I would say, though, making sure you have an investment thesis that's already essentially baked, that the management team is well prepared for those meetings. Ideally, when you get into the roadshow and the analyst day, you haven't had a full turn of the materials and completely reinvented the story. And so the goal would be to go into those meetings with an investment thesis that you think you can bring through to those other events as you get into the IPO process, and then incrementally update it based on the feedback that you hear in those meetings.
Great. Brad, anything to add there?
No, I would agree with all of that. One, again, slight difference that we need to keep in mind now, and one of our earlier panelists mentioned the backlog or the pipeline that is out there. And I think that should impact the strategy a little bit on this. On this one of these big IPOs I was working on, the bankers actually reached out a couple of weeks ago to start booking meetings internationally and in the US. And some of the feedback they got from the big institutions is that, listen, we're being inundated with these things right now. Absolutely inundated with testing the water. So it may question the theory of whether Q1 could be busier if some of these meetings turn out well. But what I think that's caused us to do, and I think similar issuers, is really make sure that you're going into those meetings tight and ready to go, that you may not have some of the flexibility that you've had in the past because there could be a whole lot of people competing for the attention of these investors.
Gotcha. When it comes to telling the company's story, surely many CEOs, are just the kinds of people who want to take charge and tell that story. But when we spoke last week, folks, I think that the consensus was you should let the advisors who are practiced at this. I think Craig stepped out, but it should be Craig telling the story, not the CEO. What do you? Let's ask the attorney first.
Yeah, so I certainly think it has to be driven by management. The people who are going to be telling the story need to be creating that story, and it has to be authentic. And investors are really smart, and they'll be able to see through that if it's not. That said, your advisors, your bankers, and your IR advisors do know the audience well, and they need to be consulted on that. And finally, I wouldn't be a lawyer with saying you have to listen to the lawyers a little bit. The best story and the best IPO in the world, it does you no good if you end up in jail after the fact. So, yeah.
Yeah, all right, remember that one. Sherry,
Sorry, I
Leo.
want to just add that it's true, like from the lawyer and the IR and the relationship point of view, but I think from a consulting point of view, accounting consulting, we need to be careful because lawyers and CEO tend to actually put inside the business section and other section of the proxy statement information that might be different from what is inside the financial statements, which can result with the SEC commenting and giving us a lot of leather because they're talking maybe about a facility that doesn't exist in the financial statements or something else that is in their mind, but actually doesn't reflect into the numbers. So it's good to have a coordination across the board because you need to make sure that the story is right, but at the same time it's also reflected correctly inside the financial statements.
Sherry, anything to add to that, or you largely agree?
Yeah, no, I agree.
Okay. This might sound like a dumb question, but I mean, how important is it to make your first quarter or two in this environment? I mean, I feel like in the early days, as the IPO window opens more broadly, I mean, obviously, if you whiff on the first quarter in any environment, you're going to get punished, right? But Sherry, what are you telling clients about this?
Yeah, I mean, that's absolutely true and probably never more so true. And I think we even talked about this a little bit yesterday. I think the two key things to keep in mind in those, first couple of quarters out of the gate, you must hit your earnings and you must hit your reporting deadlines. And one of the things to keep in mind is as you're putting projections out there and giving guidance, you don't want to give your stretch case because that just increases the chances of, potentially missing. So you want to keep a little bit of buffer. What investors are looking for is growth over time, and so you want to be able to tell that story quarter over quarter. So I think those things are really important as you think about the message that you're putting out there.
Anything to add? Anyone down there?
I couldn't agree more. And this is true when you're earlier in the process and we were going through Analyst Day and sharing a model with those sell-side analysts that may not end up being part of your public disclosure. Keep in mind that that's going to become your consensus, and that's what you're going to be held accountable to, because that's what the sell side's going to put out in their models.
Makes sense. The next boom in IPOs, as we've talked about on a couple of these panels, actually, is likely to be regular way IPOs versus SPACs. We were talking about, I think, an estimate for maybe 5% of the peak for SPAC volume or something, which is just incredible. A constraint that a company doing a regular way deal has is an inability to speak to the media for a long period of time. And it's interesting because a few years ago when we were all locked up in our houses and apartments, we were talking to CEOs of these companies that were SPAC targets, all day long. And, that I don't know if that was healthy or not, maybe a different question, but if you are doing a regular way IPO, what is your advice? Because, investor relations and media relations are very closely intertwined, as Hunter knows. So Hunter, how do you approach that?
Yeah, look, I think you've got to start early. I think that's the thing that we see is a lot of companies wait until they're almost ready to launch the IPO to start thinking about what they need to be saying externally. And that's too late because you're heading into a quiet period. So the sooner that you can start building that profile as a business as usual case, starting to build executive visibility so that the market knows your CEO, knows your CFO, I think that helps you as you get into the process and need to go a little bit darker. And you also have set precedent that that's your business as usual cadence. So obviously you can't talk about the financials, can't talk about your go forward outlook, but you can still continue to do business as usual media. And so setting that precedent early on, I think sets you up much better for the IPO process and beyond.
Well, I would imagine that accomplishes a number of things. One is relationships with some of these news outlets because they'll remember that you cooperated and gave them some time. It's also going to be, if somebody has never heard of a company, the first thing most people do is Google it, right? So some companies obviously already have problems on Google, but what if there's nothing there at all? That's not great either, is it, Hunter?
No, 100%. I think you need to use your corporate channels as well. Make sure that those are built out before the process. Casey from our team is here. She's our head of digital. She can help you with all these types of things, and I know she'll be on a panel later, but making sure that the owned channels that you have, your website, building out your IR website in advance so that that's ready to launch as soon as you go public, LinkedIn. Also, don't forget your employees and your other stakeholders. Bring them along for the ride throughout the process as well.
Gotcha. We already talked about cross-border deals, but I kind of brought that question up earlier than I'd planned to. Do we miss anything on that, guys? Because the question that I was going to ask is, will the international deals follow the domestic deals? And I think that's probably what everyone expects, right?
Yeah, I do think that's the case. I think people are getting ready and waiting to see what the reaction is to some of the big U.S. ones that we think are ready to go.
By the way, are there any particular, not to bully them, but are there any particular exchanges or markets that have lost favor? Companies that, have had it with London that are coming to the US or anything like that? So I don't mean to be disparaging, but where are these folks generally coming from? Obviously from our friends up north, but Leo, how does Europe look?
I think my experience has been, we've seen a lot of cross-border coming from East Asia, especially like in the biotech and tech company, like AI companies as well, coming from Asia. We've seen a lot of companies, surprisingly, also from Vietnam, not just China and Singapore. We've seen also company coming from Vietnam. We see company coming from Australia. In Europe, is a little bit different. I think European companies still tend to prefer the Euronext to the United States market for a series of regulation that actually a little bit easier compared to the United States, but they still try to do either a dual listing, like a both location, like the Euronext and the United States, or either just maybe pointing into the United States when they want to have more access to the capital. But we've seen a lot of company coming more from East Asia rather than the European company.
Gotcha. Brad, you largely agree with that?
Yeah, I do. I think the fact is that the relative size and scale of the U.S. markets relative to the rest of the world has increased exponentially over the last 10 years, and that is causing companies from all over the world to look here for capital. Yeah,
it's interesting. The one country I was thinking of was Australia. I've seen a lot of Australian companies leave, and I think that market may not be that friendly to growth companies. So in fact, they often go to Canada. I've seen that happen.
Absolutely.
Now let's just talk about the question of going public at all. So as the gentlemen from GameSquare were talking about, they merged with another company because the costs were becoming, too much to bear, and they wanted scale. Also, going public doesn't look like much fun if you did it, at the end of that last boom. I know that you're not in the business of discouraging companies from going public, Sherry, but I mean, do you have some of them saying, well, because one thing I used to hear was we can't get the check size from Silicon Valley that we can get from an IPO, and I don't know that that's the case in this market. So, what does that conversation feel like, Sherry?
Yeah, well, I would say a lot of companies are evaluating exactly that. Can they get the valuation that they're looking for through a sale transaction versus an IPO? And in a lot of cases, they can. And so what companies typically are doing is what we call a dual track process. So they're pursuing both getting ready for an IPO as well as an M&A transaction. And so it just keeps optionality open for them. And if the price is right in a strategic acquisition, I think 9 times out of 10, maybe even 10 times out of 10, that's what companies are going to gravitate towards because of the high cost and burden of being a public company.
Makes sense. Anyone want to add to that?
Yeah, I mean, I think it's correct. Like, I think I've seen like a sort of a dualism between growth and profit. So I think the company tend to choose one another according to the valuation of the company, also depending who backed the company. So let's say that if a company is backed by a private equity or venture capital, most likely they will go for a sale rather than an IPO because they'd rather go for a full exit because they know that the private equity will lose all control from the company if they go IPOs. On the other side, if the company is an independent company, it doesn't have a strong dependencies to the private equity, they will go for an IPOs. Because at that point, like, they will not prefer a sale because management will lose control of the company, and most likely there is new management coming in. So it's kind of a both, like people are preparing for both. It's kind of costly for a company to go on the dual track. So it's not that easy process for a company because you need to be prepared also from a compliance point of view. But I think that at the base, there is not just the market, but also some strategic thoughts about what is the best way to go out.
Great. Let's talk about the role of the retail investor, guys. So, right out of the gates, I mean, I know if I can say out of the gates. Before they got out of the gates, some of these companies in the last cycle became meme stocks. Remember Lucid Motors? That was a wacky situation, right? Before the de-SPAC even happened, it was trading at $50 or something. What do you tell clients when it comes to retail investors? I mean, I don't think anybody wants to become a meme stock, but sometimes you get a big retail following. So is that part of, the prep process for the four of you when, obviously, you don't look for retail investors, but isn't it something that can happen, particularly if it's a well-known consumer brand or something like that, Sherry?
Yeah, it definitely can happen, and I think certainly something for them to be watchful for. I think Brad, you had some comments on it as well.
Yeah, I think we certainly saw that play out a lot at the end of the last boom. And I think what it underscored for me, and I unfortunately had to live through one, not quite meme status, but close enough, it underscores the importance of building your book properly, your order book on the IPO, right?
Yeah.
And the importance of getting a really solid foundation of long-only institutions that are willing to sort of sit there and support and are not going to sell as the stock begins to trade up. And that can be obviously tough to control, but you have to do your best. And it could result in you leaving value on the table in pricing. One of our earlier panelists talked, I forget the term he used, but leaving something on the table when it comes to pricing. And I think, some of our clients who went through that would have said they would have done it differently. They would have kept a little value on the table, taken a little less pricing on the IPO to put the stock in the hands of people who are going to hold it and not let it flow out into some investors that can cause the story to get out of control.
Well, I mean, wouldn't that also be very prudent for the investment bankers who are advising how to price the deals to, do it conservatively so that we get some good trades out there?
100%.
Because if we don't, everybody's going to get spooked, right?
100%, and that is a key role of the investment banker is that.
Well, it's funny because I don't know if you guys agree with me on this, but when I look at, my places I used to work, like CNBC, they always try to make fun of companies for leaving money on the table. And I'm just thinking, well, isn't there more to it than that? Isn't that short-sighted? Hunter, do you hear this too and get annoyed by it?
A little bit, yeah. I mean, this also goes back to the conversation earlier about the model that you're giving analysts. I think making sure that you're being reasonable in everything that you're putting out there throughout the process so that you're not getting that initial pop, but then you're not prepared to operate as a public company, or you're going to miss that guide in the first or second quarter that you're out and do a lot more damage than good. It's really easy to lose credibility. It's a lot harder to gain it.
Yeah, and maybe just one thing to add, I think one of the key things that companies are watching for as they're seeing who's going out is that aftermarket, after IPO performance. And so it is important to have that ability to show gains and growth. And I think that's what's going to create momentum in the IPO market as well.
Great. Well, this is a CorpGov forum. Let's talk about corporate governance for a second. Brad, let's bring you back in again here. So how important in this environment are you telling clients when it comes to board composition and, more broadly, corporate governance? Are investors looking at this more closely than ever?
I think so, absolutely. And many people might say that a company is not subject to attack earlier out of the gate because you've got a large shareholder, a sponsor, or otherwise. But I think we've learned that that isn't always the case. And certainly, I tell clients there are thousands of decisions that clients are faced with when going through an IPO. By far and away, from my perspective, the most important decision, and it's not even close, is the composition of your board. And you can have a lot of different stakeholders with seats at the table asking for certain things. And at the end of the day, the sponsor, the management team need to ensure that they help put a board in place that is supportive, knowledgeable, ideally somewhat immune from attack from others early out of the gate. You've got enough other issues to be dealing with as a new public company. A weak board should not be among them.
I think that, for example, for what we do, like in putting together the IPO readiness deck for the company, we actually have a section assessing the board composition, as you just mentioned, because it's important for us to go on the company, having conversation with the actual board, and make recommendation if the board is actually makes sense, or you have to add or like remove those people, adding other people. So definitely the composition of the board is one of the most important aspects.
The only thing I'd add is we did an investor survey earlier this year. It feels like 3 years ago, the pace of the market. But one of the top things that they said is, governance is very important to them as they're evaluating IPOs. And what that means is they're looking for boards that have been recently refreshed and that are diverse. And on the flip side of that, the biggest red flags they called out were dual class boards as well. And they want a sunset provision when you're talking about those dual class structures in the first couple of years after IPO.
Great. What about activists? How soon after an IPO have you guys seen clients, or actually would you advise them to be on the lookout for an activist appearing? I mean, particularly with a lot of those SPACs that went down, there was a great discussion of that. Can these be bought, for $1.50 and fixed and that sort of thing, and everybody gets fired? Is that something you tell everybody your clients to look out for, Hunter?
Look, I don't think you can ever be prepared too soon for activism. Now, obviously, there's some things where you can be insulated but not immune from an activist, depending on your ownership structure. And we've also seen, if not an IPO, in a SPAC or even a spin-off, activists come in very quickly, especially if you miss that first quarter or you miss that second quarter. And so, I'd say insulated but not immune. Always have a plan in place, understand your vulnerabilities early, because even if as a result of the structure that you have, you don't feel like they can really make a lot of change, they can still be a huge distraction as you're trying to operate the company.
Makes sense. Brad, how about you on the legal side? I mean, are you bringing John Feldman in to talk to companies before the activists? How does that work?
Unfortunately, yes. And you're gonna talk to a couple of activist lawyers I know later this afternoon, some of whom are involved in a pretty public fight right now over one of our public companies that just recently went public in the latest wave. And it is a reality.
Wow.
And again, underscores the two key points I made earlier of ensuring that your order book is filled with some long-only friendly investors and you have a proper board in place out of the gate.
As a follow-up to that, everyone, there are things that happen like a dual share class or a concentrated shareholder base, which could exist very often in the case of a private equity-owned company going public because they don't sell it all at once. They take a couple of years. So I think that they might feel insulated from an attack. That one of those protections, I guess, is temporary. But do you still see instances where activists make noise regardless, and the companies get blindsided because they think there's no way anyone's going to go after us? Hunter?
Again, I'd say it's insulated but not immune. So you've got to be prepared regardless of the share structure or the board composition, and make sure that you've got a vulnerabilities assessment in place, that you have a plan in the case that somebody comes knocking, and that you're prepared for engagement.
Anything to add down there, Leo or Brad?
No, not from my perspective.
We got a couple minutes left. Any questions from the audience for this group here?
So I think there's a bit of a mixed bag. There's certainly companies that are in the pipeline and in backlog right now that are prepared and are sort of watching for the right time to go, but there's still a whole host of companies that are still in that getting ready stage. And I think it's going to be sort of the momentum starting. I think we need a few to go out and to be successful from a price perspective to actually create some more momentum. And the ones that have been getting ready for several months, even maybe a year or so, are going to be the ones to hopefully go first.
Anyone else?
Yeah, I think that's right? So I think there is this kind of approach that I usually call like wait and see. There are maybe a few subset of companies that are 100% prepared to go public, but they are still there, waiting what happens to the market, figuring out if there is another company within the same industry on the same exchange, how actually does stock fluctuate before actually make the move. So there are companies ready, but they're still in the moment where they don't want to go first, so they want to wait for another company to go first and then follow. And I don't know when this is going to break because everyone is waiting for each other. So.
Well, let me turn this around. We talk about preparedness, but even with all the advice that companies get from the four of you, is there something that you see, like a mistake, something that's not being taken seriously enough, that's leading to poor performance or poor reception by the market, Leo?
Yeah, I think that's right. I think that, especially when you talk with the CFOs, I think that people don't understand the full picture of IPO readiness. So CFOs are more concentrated on the systems rather than the financial department or rather than the compliance or internal audit. So they don't have all the pieces together. So I think that a consultant like us can actually go there and listen and talk to them and say, listen, yeah, this is important, but it's not the only piece important for an IPOs. I mean, you need to make sure that you are able to file reporting correctly, that you have a finance department in place that can actually crunch the numbers. And I don't think CFOs take this that seriously till like a couple of months before they really want to go public, when it's actually too late and you have to work crazy hours to actually meet the deadline.
Gotcha. Sherry?
Yeah, I would just echo that. I think probably one of the biggest sort of pitfalls is that companies underestimate the level of effort that it takes to get ready to go public. So I have seen that be more acceptable. Companies have sort of gotten their head wrapped around the fact that a down round is a likely scenario, and they have to be in it for the long term, right? If you look at the trends, even companies that have had down rounds, if you look over time, their stock price has significantly exceeded what their highest round was. So it's sort of getting your head wrapped around the fact that it's the long game. It's not just the IPO price.
Great. Okay, I think we're going to wrap it up. Move on to the next one. That was terrific, guys. Thank you so much.